So in today's video we're going to take a look at balance sheets. Now in a previous video we've looked at what is profit, and a lot of investors look at profit and loss accounts, and as long as profit's rising they think, great, this is a company I want to buy. But actually that can be a mistake. You need to look at the balance sheet as well. It's not the most exciting document to read, it's got a lot of numbers and a lot of jargon in it, but without a balance sheet you can't really get a sense for what a business is maybe worth and what its therefore sort of long-term prospects are. So this video is all about what balance sheets are for and the very basic types of information you can expect to take away without getting buried in the jargon and the accounting buzzwords. Okay, so where do they fit in? Well, accounts basically can be divided into three important statements. Buried right in the middle of the 100-page document we call a set of accounts, you'll find a profit and loss account, a balance sheet, and a cash flow statement. So let's take a look at those first two. In essence, what you've got is this. Every 12 months, the directors will prepare a balance sheet. As such, it represents you freezing the business and taking almost a photograph of where it's at right now. And you'll notice the balance sheets are prepared at specific dates. So for example, you might have a balance sheet prepared at the 31st of December for a particular year, say 2010. Another popular one is the end of the tax year for companies, so quite often you'll find 31st of March 2011, let's say. The point is, the directors pick a point in time, the end of the trading year if you're a retailer for example, sort of around Christmas time let's say, or the end of the tax year. They're quite popular, but certainly not the only options. And you prepare a snapshot. See balance sheets very much as taking a photograph at one point in time. Now as such, it's a slightly artificial exercise. Balance sheets are out of date almost as soon as they're prepared, because of course in reality businesses don't just stop, they keep going. But nonetheless, as a quick snapshot of what a business might be worth, balance sheets can be quite useful. And usually they're prepared at 12-month gaps to keep the accountants happy, with possibly an interim statement somewhere in between, say every 6 months or even every 3 months. Now, just worth noting that although we're going to focus on balance sheets, if this is a 12-month period, a profit and loss account is more of a story. It tells the tale of how the business got from here to there, and hopefully the answer is by making profits. In other words, the business grew. So although this video isn't about profit and loss accounts, see the profit and loss account as more like a cine camera, capturing everything that's happened and summarising it between two balance sheet dates. Then the balance sheet is a photograph. So the language of profit and loss accounts is sales, revenues, minus costs, to give you a profit. It's a story. Sales will have been made January, February, March, April, May and so on. Costs will have been incurred and they're just summarised for each 12-month period. But really, for a sense of what the business might be worth to an accountant, let's say, you want the balance sheet, the snapshot. So what is a balance sheet? What makes it different to this thing, the profit and loss account? Okay, well, basically, balance sheets are simply quick snapshot statements of net worth. So, sounds very flash, actually very simple. A balance sheet is simply a statement, if you like, of what they own minus what they owe other people at, let's say, the 31st of March. The difference is known, not surprisingly, as the net position, and then at the bottom, the reason they balance is you answer the question, how has that net position been funded? Balance sheets balance because those two numbers should be the same. In other words, you can't conjure net worth out of thin air. It'd be nice if you could, but no one I've yet met can do it.